The following program has been pre-recorded and is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, I'm Esther Gulius, the tax lady from EG Tax. And I'm joined in studio with Christopher Fabian, and we're going to do emails and text because they're so popular. People said, we really like that. So we're doing one more segment this year, answering your emails and text. And so... anything you want to say, Chris? Do you have anything to say to yourself, Chris?
Well, hello, Esther. But if you're getting letters, and there is the common one, the identity letter, that is a true and accurate letter. You do have to do that. It is a pain in the butt, but it's not that hard, actually. Just getting a hold of the IRS could be the pain in the butt. But any other letter you get, give us a call. Don't just
pay it. Don't assume.
Yep.
Because the IRS in the state of New York come up with a digital run of everything that's been provided to them, and they don't know that some of this might be self-employment income, or this was a rollover, or whatever the situation is. When you get those letters, make sure you bring them in. There's no charge, and we're very happy to help you.
Right.
But we're going to talk some emails and things, right, Chris?
Right. And speaking of letters, tax lady, I got a letter from the IRS saying that I owe them $40,000 because I didn't claim my crypto sales. I thought they weren't government regulated. Ben.
Yeah, well, They're absolutely another form of capital asset. And so when you sell cryptocurrency, you have to report the difference between what you paid for it and what you sold it for. So assuming that you had a cost basis on your cryptocurrency that you can prove, you can then do a Schedule D and mitigate some of that capital gain.
Right. Yeah. The thing is, they're not government regulated, which means there's no backing to it, okay? And the financial companies don't have to do the reporting that they normally do. So since it's not government regulated, the government doesn't know the cost basis, was what Esther was getting at. Unlike if it was just day trading, the cost basis is reported. So here, you probably had $200,000 worth of sales. And they're just coming at you guns a-blazing, and now it's up to you to provide your basis.
Your cost basis, right.
Right. You may actually have money coming back.
And actually, some of those, like Robinhood, they do provide that to their customers.
Yes.
So if you want to make your life easy, make sure that you know if your broker is going to keep track of the cost basis so that when you do sell it, you're not going to end up with a great big capital gain because you don't know what the basis is. It's up to you to know the basis.
Right.
I mean, you just can't go to the IRS and say, well, gee, I don't know. I think I paid. You have to keep your records, so it's really important.
Yep.
The bottom line is probably he doesn't owe this.
He won't owe $40,000. Right. He may owe a couple bucks. He may get a couple bucks back.
Right.
So, but don't ignore it. Is the whole thing.
Well, if you ignore it, then it just gets worse because then they send you another letter and another letter that's a demand letter. Then they just come and garnish everything. So you don't want to do that.
Right. And, New York State sends out letters. This is the federal. If you ignore this, the federal puts it through, then you'll get a letter from New York State as well saying, hey, we got notified from the federal. They changed your return. Guess what? You now owe us money too.
Right. And because they, especially if that went through, then it's very difficult to say to the state, wait a minute, I shouldn't have paid the federal, because then they're going to say, oh, well, the federal let us know that you did pay the taxes on it. So it becomes even more difficult.
Right. Please bring in the letters.
Right.
Let us take a look.
Don't ignore it.
Yes, exactly. So just be smart. And then next we have Michael from Cheektowaga. I heard you say a Roth may not be my best bet. I make $70,000 a year. I'm 30 years old and just started a 401k plan. If I contribute $3,000 a year over 30 years, I should have around $200,000 in the plan. Tax free. Isn't that better than paying taxes?
Okay, so probably this person is not going to, doesn't look like they're going to have a pension plan provided by their spouse, like in New York State. So it's true, when he goes to retire, he'll have $200,000. But that $200,000, if it's an annuity or if it's a pension or IRA, most people are not going to take it all out in one day.
Right.
They're going to spread it out over their longevity. That $200,000 spread out over 30 years is like $6,000 a year that you would take out. If that's your only source of income with the Social Security, looking at what the projected standard deduction would be, you will pay no taxes when you take the money out. So you've just given up tax write-offs of $60,000 on the left-hand side, and you're not going to get any benefit when you retire because it wouldn't have been taxable anyway. Not all Roths are a good idea.
Right.
They're not for everyone. You don't want to, and there's several things. You're giving up the tax deductibility when you make the contribution, number one. Number two, you don't know how long you're going to live, quite frankly. And so you're looking at something for when you're 70, but you may not live to be 70. And number three, they might change the tax code. So if you're not somebody that's got a secondary or a source of income or a secondary pension plan, seriously think a lot about not using a Roth, because you're giving up the tax deductibility now in exchange for something that may never take place in the back end.
Right. And who knows, like right now, starting your minimum distribution is age 73. In a couple of years, it's going up to 75.
Right. And by the time this person retires, it might be 85.
Right. And under current law, $200,000, your minimum distribution is only $7,300. So like you were saying, your standard deduction is much better than that.
Right.
So you pay no taxes. So here, a single person, probably 12, maybe into the 22% bracket, just cost himself on, 3,000 times, we'll keep it 12, $400 or $360 a year.
A year. Right.
Not counting the state.
Right.
So where, again, the state, the first $20,000 is tax-free on your return,
pension.
on
Right.
your pension. So now that's $180. So $360, that's cost him over $500 a year.
Right.
So times that by 30 years.
Right, and it's probably and assuming that maybe he even increases his contribution. The bottom line is, with your standard deduction going up, many people are using Roths to reduce their liability when they retire, but the truth is they're not going to pay the taxes anyway.
Right.
So you gave up the tax benefit when you put it in exchange for something you're never going to pay taxes on later. And of course, that doesn't mean all situations, but the average worker without a pension plan provided for them at work, unless you're working for the state of New York, county government, or you have a big salary and maybe self-employment, the Roth may not be best for you.
Right. Yep.
Okay, what else we got?
I think it's break time.
It is break. I'm Esther Gilias, the tax lady. We're going to take a short break. We'll be back in a minute. Hi, to us, your family. This is Esther Golias, the tax lady. We're doing emails and texts today. So I've got Chris Fabian in studio with me, and we're just chewing up texts and emails. So what else we got, Chris?
Thomas writes in, my girlfriend lives with me and her 2 small kids. She has a small part-time job, but I pay all the expenses. Can I claim all of them on my taxes? She makes less than $8,000 a year. Just enough to pay for daycare while she's in college. I hear I get head of household too, right?
Okay. Well, this is very interesting because that's what a lot of people think. I'm paying all the bills for these kids to live in my house, and I'm furnishing over 50% of their total support. So why can't I claim them? Well, he could claim them, because he probably is giving 50% of the total support. He could claim the 3 kids and but not the girlfriend, because she has taxable income over $4,400. So what would the 3 kids save him in taxes? $1,500. That's it. Because they're not his children.
Right.
If they were his children, or if he was legally married to the wife, to the girlfriend, and they became his stepchildren, then those 3 kids would be worth $6,000. But that's not the case. They're not relatives. They live in his home, and so all he's going to get is the other dependent credit of $500 apiece. Now, let's look at this from her perspective. On her $8,000, she had, those are her children, and she lives with them. She qualifies for the earned income credit.
Right.
And the child tax credit.
Right. She'll file single
right.
with the children and get the EIC.
On federal and state. Yep. And I think I heard that she's paying daycare.
Right.
He said just enough to pay for daycare and for her to go to college. So, Mamma Mia, if she is a freshman or if she's an undergraduate, she might get the education credit as well.
I'm hoping she did her FAFSA, because $8,000 with 3 kids, she should have paid. She should be paying nothing for school.
That's true. But that's something you have to explore, though.
Yep.
So when I hear this, I think I got to explore the
everything,
education
all
credit.
the avenues.
I got to explore the earned income credit. I got to explore the daycare credit, because maybe she had daycare provided for her by the county as well. But the thing is, she's going to end up with, so you're saving $1,500 in taxes, but because of the earned income credit for her, she's probably looking at about $6,000 in refunds, plus whatever's left over from the additional child tax credit.
Right.
So $7,000 or $8,000. So it's a lot better for her to get $7,000 or $8,000, and you give up $1,500.
Yeah.
Because you can't be head of the household either.
No.
Because none of these people are related to you.
Yes. Correct. So.
Yeah. So that's the way. So marry the woman, and everything changes then, doesn't it?
Yep.
If he marries her, then those are his stepchildren. He would save $6,000 in taxes, and obviously her $8,000 would go on his tax return. So, and it all depends on how much money he made. If he made maybe $24,000, he'd still get the earned income credit then at that point in time.
Yeah. So, okay. It
ain't easy.
It is not easy. My friends got a New York State refund last year of $350. I don't know how this can be true. They only received Social Security and a small pension of $200 a month, just like me. Sue.
I know. They qualified for the Pt.229.
Right.
And so they obviously were homeowners.
Yep.
So if you are somebody that is paying property taxes, even though you don't have to file a return and your income's low, the state of New York, provided you had a large enough property taxes paid, can give a credit to your refundable credit of anywhere from $250 to $350 if you file the IT-229.
Right. And New York State has a lot of different credits out there that people aren't aware of. I mean, there's that one. I mean, the volunteer firefighters, most of them know all about that $200. Yeah. But you still got to tell the preparer.
Right.
Because if you don't tell them you're a volunteer firefighter, they're not going to give it to you. There's the 249, the nursing home
Credit if you're paying if you're a
If you're
private
paying-
pay
Yep.
patient at a nursing home, there's a 6% bed tax, and they'll give that back to you. They shouldn't be they shouldn't be charging you, but
Right.
they give it back
But
to you.
that-
But you got to do the form
I mean, that's $10,000 a year, at least.
At least.
so that's a big one. The college credit.
Yep. The earned income
Income
credit,
credit,
the daycare
daycare
credit, which this is interesting to me too. People that are paying daycare on the federal, maybe they don't benefit at all because it's not a refundable credit. But on New York State, it's a
is.
refundable credit,
Yep.
right?
Yeah. So, I mean, look into the New York and see what's out there. I mean, this year it wasn't a credit, but the healthcare workers got the
That up to $3,000 as an
Yeah.
adjustment.
Yep.
So if you were a nurse or a healthcare worker, and you got that bonus because of working during COVID, you could take a deduction on New York State of up to $3,000 of the money you got. A lot of people didn't get any. They're supposed to get it this year. Some people got $1,500. Some people got $3,000. But it was an adjustment, which would save you money.
Right. Every little bit helps.
Right.
Okay, I'm going to combine two emails because they're both about the same. Phil first writes in, my father just passed last year, and I'm splitting his IRA and 401k between me and my sister. Is there anything I need to know about? Can I contribute to the new one that I opened for this inheritance? So there's that one about a death. And then John writes in, my mother passed away last month. I have inherited her home and some stocks. If I move into the house, will I pay taxes when I finally sell it? So they're both involving death of parents. So which one do you want to tackle first?
Well, I'll do the house first because that's
Okay.
easy. He inherited the house. It sounds like he's going to move into it. If he moves into, first of all, if he inherits the house, he gets a stepped up basis. So if he sold the house, he wouldn't pay taxes right now. But that holds true if he hadn't inherited the house and it was gifted to him and he moved into it for at least 2 years, then he wouldn't have paid taxes on it anyway because he's living there and the first $250,000 would be tax-free if it became his personal home.
Right. So if it was gifted, I mean, what I would if he wanted to, and it sounds like he's going to move into it.
Sounds like he wants to move in.
Right. He could sell his current house, make the money tax-free, move into this house, live there for 2 years, sell that house
Tax-free.
tax-free 2 years later for the
Right.
I mean,
But somehow when you tell people to do this and it's their home, it's like they go, oh my God, you mean I'd have to move twice? Yeah. But to make the money, I had a client in Florida who paid $390,000 for their personal residence. And Florida real estate went nuts. Then his wife didn't like where they were living. They moved into another house and turned their first $390,000 house into rental. The second house, then they paid $600,000 for it, and then they bought a little villa to rent. Well, when the property values went crazy, they sold the $390,000 house for $930,000. They sold the $600,000 house for $1.2 million, and they sold their villa that they paid $400,000 for $650,000. They became millionaires off of real estate. Their personal residence was tax free.
Yep.
They had to pay taxes on the 2 rental properties, but one of them ended up being a 1031 exchange.
Yeah.
So they were very, very happy, and they're very rich right now, and they're very happy. And using real estate, there are some great benefits to real estate.
Here, John could make $500,000 tax-free in 4 years.
Right. People would, and people are always looking for loopholes. Your property that you're living in is a loophole. And I know what people are going to say, but where, because I can remember this gentleman when he sold his house, and he said, I don't know what to do. And it was really interesting. He just happened to find another house down there that he made out on as well. And he's thinking of selling that.
Yeah. Well, I mean, I just think of the show Love It or List It.
Yeah, that's true.
And these people, oh, well, I'm just so attached to the house. And I'm like, but it's a house.
Right. It's an asset.
Right.
It's
Right.
and it can really set your finances really in order.
Right.
By doing
So
this.
Okay. You'll make memories in new houses.
That's right.
So
Especially when you have a bank account.
and you could laugh saying, I just made all this money and I paid no
and I
taxes.
have a bank account. All right,
So
but
then-
the second half.
Okay, about inheriting his dad's IRA and his 401k. And what does he need to know? And can he contribute to that one as well?
All right. Well, that's kind of a problem because if he inherited it himself, then the 1099-R is going to be in his name.
Right. Well, his portion would be in his
Okay,
name.
that's
and then-
not what he said.
Right. Well, yeah.
I mean, if the whole 1099-R is in his name and he gives half of it to his sister, what can he do? Right?
He's going to pay tax
Right.
on.
If Dad had it set up that way, that he was the beneficiary and he got it, then he's the one going to pay taxes on it. He's rolling it over. Obviously, I can see
Yeah.
that.
Yeah.
But and so he'd have to take it out over a 10-year period. He can't give half of it. But now if it was for him and his sister, then he gets half, she gets half, and they have to roll it over. I'm assuming they'd roll it over.
Right.
Into
I mean,
their
and there's a lot
beneficiary IRA,
more.
and they
but-
can't contribute to a beneficiary.
Right,
IRA.
and we can talk more about this after
Yes,
the
because I'm
news.
going to take a break for the news. I'm Esther Golias, the tax lady. We'll talk to you on the other side. Hey, to us, your family, and this is Esther Golias, the tax lady from EG Tax with Christopher Fabian, and we were talking about inheriting stuff and real estate. And so are we done with that?
Well, no, because, let's talk about this. This was Dad's 401k and IRA.
Right.
And, okay, so he's doing the right thing. It sounds like he's rolling. He had opened a new one, so he rolled it over,
Right.
so he's not going to pay tax.
Right.
But what are his distribution laws for this inherited IRA? He's got to take it out over 10 years.
Right.
It's not something he can wait till he's 73
Right.
and then start taking it. No, it's got to be taken out over 10 years.
Right.
So that could be a big thing, but depending on the dollar amount. But if Phil is still working, it doesn't say, what he could do during these 10 years, if he is working, is max out his 401k at work. Because then he's living
To
off...
mitigate the
Right.
tax liability.
Yeah, basically he's rolling it over into his own plan
Right.
by contributing through his paycheck, but he's living off of the old one.
Right.
So he's really not going to be paying any more tax than he was.
And the other thing is, let's say he's retired.
Yeah.
If he's retired on Social Security and we don't know how much that he got, his distribution might only be $4,000 or $5,000 a year.
Right.
He could take it out and not even pay taxes.
Yep.
So there's so many different variables.
And
But the important thing is, I know they emailed us, but I'd suggest you call and come in, and we'll sit down with you and go over and make sure it's all good.
Right, and I know I'm thinking of one family in particular that we did advise them, make sure you roll it over into IRAs, into beneficial IRAs. And none of them did it. And they came in to get their taxes done, and then they got mad at us because they had to pay taxes on it.
Yeah. Well, and the other thing is, I can think of another client that inherited IRA. He went to the bank and said, I would like to roll it over. And the banker talked him into putting it into not an IRA, but an annuity. And so the whole thing became taxable. If we tell you to do something and a banker says, why don't we do this? Before you do it, say, I want to just check with EG Tax to make sure, because that whole amount, because he didn't roll it over into an IRA, he just put it into an annuity, and that made it fully taxable. And plus, it's tied up for 5 years with all kinds of fees.
Right. I mean, you really got to watch what you're doing. If you can have, what I tell my clients is, have the financial institution fill out the forms for you where you're putting it, because then they're handling the transaction. It should be done right.
Right.
But you still got to double check.
Right.
But if you get that check, there's so many different variables.
Well, once you just have to understand that people, even bankers, are salespeople. So you have to make sure that you do. I had a client whose spouse was still working. And when they came in to get their taxes done, I said, would you guys like to put money into an IRA for your non-working spouse? And they said, oh, great. So we put it on their tax return. He then calls me about a week later and he says, the banker says, I can't do this because I didn't work. And I said, you qualify for a spousal IRA. The banker didn't know, but she was not going to let him take the deduction. And so he wanted me to amend the return. I said, no, you qualify. So I cut out the part of the law. I sent it over to him to bring to the banker.
Yeah. I mean, I just took a call about a month ago that a client they retired, husband and wife, they moved out of the country. And they were taking her retirement account and rolling it into an IRA. Well, the company that was taking it or sending the money said, oh, and I'm just going to make up a country, you moved to Italy. You're not a U.S. citizen. We can't do the rollover. Here's your money.
They thought they weren't U.S. citizens because they just went to another country?
Yes.
They gave up their citizenship?
Right, and they withheld 20%.
Lord.
It was like almost $200,000.
Oh, my gosh.
And they're like, what do we do? I mean,
gosh.
so we're all human.
Right.
There are mistakes that get made.
And it's all complicated.
Yeah.
It's tax law's complicated. But anyway, so I guess the bottom line is before you do something, give us a jingle. And if we tell you to do something and we give you the law, then maybe your financial person needs to be tootled.
Yes.
All right, what else we got here?
I was thinking of putting solar panels on my house. The salesman said that I would get a federal credit of around $10,000 and a New York State credit of $5,000. So he was really pushing it. He also said their company's offering a 0% interest rate for 12 months. So with the money I'm getting from my tax return, I can pay it off within the 12 months, and it will cost me nothing extra. What do you think, Steve?
Okay, so first of all, does Steve even pay taxes?
Exactly.
And again, we're going back to what salespeople do, right?
Yep.
When a salesperson is giving you tax advice, you should really call a tax professional to make sure that the advice they're giving you is correct. These solar and energy credits are non-refundable. They're giving you money as a credit to offset other taxes you pay. If you are not paying any taxes because you don't have to file a return, you're going to save zero.
Right. So if your income, we'll just say you have a $3,000 credit, a $3,000 tax. You buy and you think you're going to get this $10,000, you're only going to get $3,000 extra.
Right. But here's the thing. If we know in advance that you are looking at this solar thing and the credits should be around $15,000, then what we would say is, do you have any taxable source of income that we could withdraw to make it taxable so that you would have a liability, so then that credit will cover that liability, and in essence you've gotten the money out tax-free.
Right.
That you have to pay taxes on later. That's the best case scenario. But if you got sold a bill of goods and you come in to see us, we can't help you. It's too late.
Yeah. Because here, like Esther was saying, if you came in first, you could take the money out. You wouldn't even have to borrow the money.
Right.
You could just pay them straight up.
Right.
And then get the credit. And
of course, if you're getting, but if I could get a 0% loan and I could get 5% in the savings account, I could take the money out, have the thing cover my liability, and make 5% off of borrowed money.
Exactly.
Right?
Exactly. So, but you got to do the planning and call us first, not after.
Right. And be willing to do something.
Well, this is...
a lot of times you tell people you can do this, this, and this, and they don't want to do anything because, it sounds so confusing. Right. So,
Yep.
okay.
Well, speaking of energy, Lucy writes in, I want to put in a new windows in my house and maybe a furnace too. How does the new energy credit save me money?
Well, back at the ranch, you got to have a liability.
Right.
If Lucy has no liability, doesn't have to pay any taxes, then the energy credits are going to save her nothing because these are, again, non-refundable credits. And the credit is like 30%. You got to first of all make sure that they are Energy Star, and if you're doing your furnace and air conditioning, they have to have a very high SEER rating. Do you know what SEER stands for?
Energy something.
It's SEER, whatever. Yeah. Very high energy rating so that they qualify for the credit. So you got to make sure that it's not just an expensive unit. You've got to make sure that they have the high SEER rating that qualifies for the energy credit. Then you are limited to X amount of dollars per item that you're putting in your home. You got it, Chris?
Yes, and I know our text board's going crazy too right now, trying to tell us. Seasonal energy efficiency ratio.
Okay. So thank you. I've often wondered about that. So first of all, you got to make sure you pay taxes. Secondly, you got to make sure that the stuff they're putting in qualifies for the energy credit, that they're the highest efficiency windows, doors, hot water tank, furnace. They have the high SEER rating that qualifies. Your person putting it in should give you something that would certify that it would qualify.
Right. And the nice thing, too, is with the new credit, it's not a lifetime limit anymore.
Which is a really great thing.
Right. It's
$1,200 per year.
Right. But windows are capped, doors are capped.
Right.
But at least, here, this person's getting windows. Well, maybe do half this year and half next year.
Right.
So then you get a $300 credit this year and a $300 credit next year.
Right. But I'll give you an example. Let's say the windows are $20,000 and you do 10 and 10. You're not going to get much benefit at all for that because the windows are limited to how much they're going to allow you to take per window per year.
Right. Well, that's why I was saying if you can spread it out.
Right. But I mean, you're saying 3,000. I'm thinking it would be. I wouldn't want somebody to think 50%.
No. I said 300, like a $300 credit this year and a $300 credit next year,
and $300 the year after. And
right. If they keep putting in new windows.
Right.
But it's something where the old law was windows capped at $2,000,
and that was it.
So 3 windows and you were done.
Right.
Especially with the high cost of everything.
Right. And I don't think they've even finalized yet the electric vehicle credits. I think the jury's still out on all of that. I mean, the electric vehicle credits, they weren't sure about where it has to be assembled. That would be assembled in Canada and the United States. So as soon as that is all straightened out, obviously we'll let you know.
You go on the IRS's website, they haven't even put out there what cars have been and how much the credits are.
Yeah, it's really...
Because the car companies have to apply to get accepted into the program.
Right.
So...
Right. Okay, I'm Esther Golias, the tax lady from EG Tax. If you need any tax questions answered, if you're getting letters, if these conversations have sparked your memory bank and you need help, give us a call at 632-7886. We're going to take a short break and we'll be back on the other side. Hey, to us, your family, this is Esther Golias, the tax lady from EG Tax, and we're just doing emails and texts. And if you have any questions, you want to email them in, you can go to egtax.com. Ask the tax lady. We're always happy to answer it. But if you want to meet with us, there's no charge. You should just give us a call at 632-7886, and we're thrilled to help you as well. And, of course, I got Chris Fabian here. So what do we got, Chris?
Okay, Connor writes in, I just moved back to New York State after leaving here in 2012. Just got divorced and moved back to take care of Mom. My income is from my new outside sales job. I've never had a job that my expenses ended up being on me, not the company. Can I use any of these to help on my taxes? Also, I have to pay my ex $1,250 a month in alimony.
Okay.
So
This guy should go commit harakiri. There's nothing too good about this stuff. Well, first of all, I'm assuming he's on a W-2. It doesn't say he's on a W-2.
No.
I mean, if he's self-employed, then those expenses he incurred, yes, they're deductible. If he's on
both federal and state.
both federal and state. If he's not on a if he is on a W-2, then those expenses are only deductible on New York State because there's no place to take employee business expenses anymore on the federal.
Right. So still save them. Keep your mileage log. Keep
Because of the state.
right. Keep your entertainment. Keep your your cell phone bills. Keep all your expenses.
Tolls.
Yep. Because that will help you. I mean, it's not as a big savings.
But here's the thing. If you're on a W-2 and you're paying your own expenses, it would actually behoove you to go to your boss and say, I would like a pay cut on my wages, and I'd like direct reimbursement for my expenses. If it's the same money, he just saved himself a bunch of FICA and income taxes.
Right.
Right?
Yep.
Because the reimbursement would be tax-free.
Yep.
Right? And it's the same money to the boss, and it's the same money to him, but he saves a lot of money in income tax and FICA.
Right. Yeah. And that would be really smart. Some companies will probably say, nah, we're going to keep doing it how it is. But if you could prove to them how they save money
Right.
too.
Because they don't have to do the match.
Right.
So if he was making $100,000 and he had $20,000 in expenses, if he said, I want $80,000 in salary and $20,000 in reimbursement, and he submits because it's a countable plan, he still gets the $100,000, right?
Yep.
But he saves FICA on $20,000 or $300, right?
20,000 times $3,000.
$3,000. So he saves FICA of $3,000,
Right.
and on the $20,000, that's income tax at 20%. He saves $4,000 in income tax there, so he saves $7,000.
Right. And the company
Saves
at
half
least
a-
$3,000 too,
right,
not
on
counting
the
any
FICA.
other
Right.
taxes.
Right.
So, I
It's a
mean,
win-win situation.
Right.
And back in the time when they were changing the law, remember we were saying how horrible it was, and people
Yep.
just took it in stride.
yeah.
They just took it in stride. I couldn't get over that more people didn't go to their employer and say just exactly what I'm showing here.
Yeah. I mean, one thing I do got to say, one good thing, not that there is a lot of good things, Connor may have gotten hit with AMT, where writing off all the mileage and all his business expenses wouldn't really have done anything anyways, because there was the alternative minimum tax. Now there is not the
That's
alternative
true.
minimum tax.
Yeah. But that's why if he does it this way, it's a
Right.
win-win.
And then the other bad news
All right,
for
and
Connor.
then give him that bad news too.
So your alimony that you're now paying is only a deduction on New York State. It's not a deduction on the federal. So looks like you're going to win on New York State this year.
Right, and you'll be glad you moved back
Yeah.
because it's one of the few states. I mean, when I do state returns, the New York State return is as complicated as the federal. Wouldn't you think? Don't you think?
It is because
And
when
and because they have the dual set of rules,
Yeah.
you know the federal for the federal, they got to know the state for the state,
Yep.
and they're completely different sets of rules.
Right. I mean, so if you're moving out of state, if you're, and you're still got to file a New York return, make sure your preparer knows New York State laws,
Yeah.
the ins and the outs, because you can be shooting yourself
In the foot.
in the foot.
Yep, absolutely. Okay, so that poor Connor.
Yep.
All right, what else we got?
Paul writes in, I own a small business and the taxes are killing me. Are there deductions I can take that I don't know about? I work out of my garage as a mechanic, so there's really no write-offs. Last year, I made $15,000 and paid $3,000 in federal and New York taxes. I thought I was in the lowest tax bracket. Why do I pay so much?
Well, the reason he's paying FICA.
Yep.
It's called self-employment tax. It's really just your Social Security. And when you're an employee, your employer pays half of this for you. So when you're self-employed, you usually don't do the accounting until you do your Schedule C, and you find out that now you owe all this money, and so it hasn't been systematically withdrawn like a paycheck would be, and so it just feels like a lot more money than you would have paid if you were an employee, but actually it's the same. But unfortunately, you're paying both ends of the spectrum. What was interesting to me is he said he works out of his garage and there's no deductions. But there is.
There is. That's an office in the home.
Right, absolutely.
So he would get part of the utilities. I'm sure he has to have some type of heat system, whether it's through the furnace, through his house, or he has a propane system in there, but that would count.
Right.
And
part of his property taxes, part of his insurance. Maybe he's got liability insurance.
Yep. The snow removal, the lawn care, because that's where people come in and see. So he's got to keep it nice.
His electric bill, all that kind of stuff, all the new tools that he might do, retooling. So all of that's deductible. And if you haven't been taking your depreciation for your office and for your home office and travel, he gets
his
travel.
Mileage.
You come in with your Schedule C that you did, because we may get you a lot of money back.
Yeah. Let us take a look.
And you can put money, your bottom line, you can put money into an SEP or an IRA. So that's another thing. Too late now if you haven't
for
done
last
it.
Year.
But something to look forward to next year.
Right. Okay. Now we got my mom is 75, and I'm thinking of having her move in with me and my wife. To make this happen, we have to spend about $100,000 to improve our house. The money is coming from the sale of her house. Can we use this expense as a deduction on our return?
No. No. Wait, your mom's selling her house is not going to cost her anything. And she's remodeling your house and you want to take it as an expense? No, that one's easy.
Right. Well, I mean, if it's straightforward, mom is healthy and you're just adding it like a in-law suite, no. But if mom was sick and you are remodeling and you're changing a bathroom to a handicapped bathroom.
With your money.
Right. Well, she could have gifted.
Well, that's different.
Right. It doesn't say that.
Right.
But,
so, I mean, so if mom gifted you the money and you did medical adaptations to the house, which did not increase the fair market value of the house, then there might be something to this. But probably I could just hear the IRS sharpening their knives and forks while they come in on that one.
Getting the new assault rifles to come to your
Yes,
house.
that's right. Yes. Okay. Do we got anything else here? Yes.
My 16-year-old got his first job. He's working about 20 hours a week. What should he claim for his withholding?
Well, I mean, I don't know how he's making an hour. If he's making $15 an hour, right? So that means he's making $300 a week. Over 50 weeks, that's $15,000, right?
Yep.
So if they're furnishing over 50% of his total support, for sure he's going to get a standard deduction, which is going to get rid of most of this. He's going to only end up paying taxes on $3,000, so it'd be a $300 liability on the federal. And on New York State, because he's being claimed in your return, he's going to have a $12,000 standard deduction. So at 5, so he's going to pay about $600 in New York State. So really, he needs $300 in the federal, $600 on New York State, and that will cover his liability. But he has to change. He's got his W-4. He's got to fill out and just believe me, they're not going to take out more than that much anyway. On the state of New York, he could end up with a liability.
He's probably going to have to do extra withholding on the state.
But he could put money into an IRA,
yeah,
which would be a great deduction for him, get him started on the right path.
Yeah, yep. But that goes, how many, like, even married couples now should come in and let us work up the new W-4 for them.
That's
because
true.
I've seen so many taxpayers this year end up owing, or their refunds were
We
dressed.
told everybody that it was bad. It was bad. That's for sure. Anyway, we just want to thank you for listening to us. I'm Esther Gilias, the tax lady from EG Tax with Chris Fabian. If you need tax planning help, you're getting letters, you got questions, don't do it first and call second. Call us first. There's no charge. We want to help you. We thank you for listening. We hope you have a great week. We have a great summer. We'll talk to you later.
Don't forget our tax course is coming up soon.
Oh, and don't forget our tax course.
Our summer series is going to continue soon with lawyers and other people to give you great advice as well.
Yeah, thanks a lot. Bye-bye.